We have to understand that the market since late September has basically been saying that foreign investors are not really willing to fund the UK's fiscal and external deficits at the prevailing constellation of exchange rate and real yields. And so we've been saying that either aggressive BOE action or some kind of a rollback of the government's fiscal plans are needed. And it seems like we're certainly closer to getting the latter there. I think if we do get a credible walkback, our preferred fair value model, which tends to anchor our medium-term outlook, it does point to a recovery at or maybe slightly above 115. But to maybe add a little caveat there, yeah, I think it's important in this episode to just remember policymaking credibility and confidence can be lost, very quickly, and it typically takes a long time to gain it all back. So I do expect some risk premium to linger in UK assets, even if you do get a complete kind of U-turn on the policies. So 115 looks like a level to fade to me if we get there. I think we're kind of trading near the near-term highs, I would say. I think once you get some more information, we probably do test back down towards 110. You have to remember the backdrop of kind of worst stagflation mix in G10 that the UK has been faced with even before the events of the last few weeks is not going away. So I think this winter is still a chance to be short the pound.
Yeah, look, we mustn't also forget, and a few of the people who are trying to say the pound isn't that bad are making the very valid point that most major currencies are losing ground versus the greenback. And of course, that is the backdrop. So with that in mind, of course, and then looking backwards and looking forwards at the US inflation data, is it too simplistic to say, Sam, that the world is just waiting for a weaker US CPI print? And then as soon as they get that, we're off to the races on risk, and the dollar will then see a significant pullback.
Yeah, I mean, I think that's one of it, all right? But there's really two pillars here that I think have been supporting dollar strength. And one of them, absolutely, hot US inflation. You need to see for the dollar to weaken kind of sequential months of weakening inflation in the US that allows the Fed to pivot or at least become slightly less hawkish, let's say. But equally important in my mind is you need global growth expectations to stabilize, right? And I really do see this winter as kind of peak pain for the global economy. You have energy-related uncertainty in Europe for sure. You're not going to have any real central banks pivoting, I think, before the winter because inflation won't really be rolling over until Q1 probably. And I think you need both of those things, right? And I think just the last thing on the US, which I think is really important, we've been emphasizing to clients, you need months of inflation of cooling in the US for the dollar to turn. But importantly, I don't think the Fed really turns until they also see weakness in the US labor market, right? And so it's a real tough constellation to get, I think, before Q1 at the earliest. And that's why we think the dollar continues to remain strong or even strengthen further from here through the winter. 2023, these are questions that we're grappling with, though.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.